Welcome back to DanTrades Mentorship. Today is Wednesday. Today we'll be talking about market structure. We'll basically talking about market structure. Over the weekend, we spoke about candle patterns, the Japanese candle patterns. So today we'll be talking about market structure, the structure of the market, and how to navigate it very well. So without further ado, we'll be starting now. Okay, so market structure. Introduction to market structure. So what is basically market structure? Market structure refers to how price behaves and organizes itself on a chart over a period of time. It reflects the ongoing battle between buyers and sellers and helps traders understand the overall direction of the market. It's the skeleton of price action, showing where the market has been and where it might go next. So as traders, as price action traders, we need to understand help the family grow. Um Basically, as I was saying, we need to understand where the market wants to go. We need to know where the market wants to go. It's very important to us because with that we can get to know the trend, we can get to place a trade, we can get to get high probable setups. If you are going against market structure, you don't expect to win your trade. No, you don't expect that. So why is it important? It helps identify. Market structure is going to help you identify all these three different types of markets and projections. Markets and projections. It provides a framework for entries and exits. Yes, price action traders base their trades on market structure. So it's going to help us know where our entries are going to be. It's going to help us know where our exits are going to be. It also allows reversals or continuation. We'll be looking over structure. You're going to see how it looks like. You understand what it means by predict potential reversal or continuations. And first, prevents emotional trading by offering a structured view of price movements. So a lot of people don't pay attention to market structure. They just enter the market and just buy, or they just enter the market and just sell. As a price action trader, you need market structure. You need market structure to function very well, very very well. You need market structure. So as I'm saying, we'll look at and see how it looks like. Then we can continue with our session. Trading view. Okay, so it looks like I'm having a problem with my trading view. So my trading view is not projecting, but I don't know. So basically, I think I have a sample of market structure. Okay, not here. Yes, as we said earlier, we have the uptrend, the downtrend, and trend. Price forms higher highs and lower highs, or and higher lows. Sorry, an uptrend is when the market forming a sequence of higher highs and still we're having problems finding the chat. I don't know why the chat is still not projecting on my screen. Um. Okay, so someone is complaining of the voice. Someone is complaining of the voice. That's the highest. That's the highest I'm getting. That's the highest I'm getting. So yeah. My chart is still not coming as usual. So interesting. So that's an uptrend. That's what I was saying. An uptrend prints higher highs and higher lows, signaling a potential upward movement in your specific price action. So this is what an uptrend looks like. You can see anytime there's a higher high, the newer one is far higher than the previous one. And anytime you have a higher low, the next higher low is far greater than the previous higher low. That's basically how the uptrend looks like. And we have a downtrend. Now the downtrend is doing the opposite of the uptrend. So price forms lower highs and lower lows in a downtrend. A downtrend is when the market consistently moves downwards, forming a sequence of lower highs and lower lows. A lower low means the market is making new lows, sellers are in control, and a higher low forms when the market retraces upwards but fails to reach the previous high, showing that buyers are weak and sellers are ready to push price once again. So I'll like to show it on my chart one more time, but unfortunately the chart is failing to show on my screen. It's failing to show on my screen. So yeah, then this is a graphical example of a downtrend. As you can see, there's a high here. This gives you a lower high, and that's another lower high, and that's basically this is a lower low. You have a lower low, and the lows continue going further downwards. That's basically how it looks like on the chart. Let's go to the next thing. We have a ranging or consolidating market. This is one of the markets we are trying to avoid anytime you're on the chart. We are trying to avoid consolidating markets. Price moves sideways between supports and resistance. A ranging or sideways market happens when price moves horizontally, bouncing between a support level and a resistance level, ceiling. There's no clear pattern of higher highs or lower lows. Instead, highs and lows are relatively equal. No clear trend direction often appears before major breakouts. Traders buy at support and sell at resistance and avoid trading mid-range to reduce risk. So we don't trade consolidating or ranging markets. It was one of the requirements the first time we had our first session. We spoke about the reason why we don't want ranging markets because it doesn't have a clear direction. It does not have a clear direction, very choppy. So we don't involve ourselves in such trades because you are going to be in a loss, obviously. So that's basically it. Um, this is how it looks like. As you can see, the top looks like a ceiling, and the down looks like a floor. That's showing the resistance and showing the support. So we are trying our very best to fight against ranging markets. We don't trade ranging markets. You either look for an uptrend or you look for a downtrend. Nothing else, nothing more. Anything ranging is out of our reach. So yeah, very important. Once again, ranging markets is out of our reach. We are trying to avoid ranging markets no matter what. We are trying to avoid ranging markets no matter what. Components of market structure. Now, there are some things you need to see in the market to be able to identify your market structure. One of them is your swing highs. Now, this is the peak formed before price declines. So you have a high, you have a low. This is the high that is formed before the retracement occurs. Now, before price moves further onwards, it needs to retrace, it needs to make a correction. Now, during that correction phase, it makes a swing high. That's a peak before price declines. A swing high is a temporary peak on the price chart, formed when the market rises to a high point and then pulls back or reverses. It's where buying pressure weakens and selling pressure increases, leading to a downward movement. I don't have a picture of that. I was supposed to show it to you graphically on my chart, but okay, finally we have our chart here. So yeah, so there's a trade I posted on the Telegram chat yesterday. NAS 100. Unfortunately, we hit a stop loss on that particular trade. But let's go deep and look for what I mean by swing highs. Um, okay, I want to look for an uptrend so that I can use to prove something. Okay, good. I can call this a swing high. Now, if you can look, this in this area, price was going significantly to the upside. Now, what you call a swing high is this area. Now, this area printed before price came down for a retracement. This area also printed before price came down for a retracement. This area also printed before price came for a retracement. That's what you call a swing high. It's the highest point before a retracement. The highest point before a retracement. Now, why are we going to clarify all these places as swing highs? The reason is we have a higher point than this area before the retracement. So this isn't going to be a swing high. We can classify this area as a swing high since it's higher than the previous swing high. So this area could be classified as a swing high. Very important. Now, someone might be wondering, why are we doing all this? These are the basics. We need the basics so that if I'm saying something, you don't get confused over the chart. These are the basics. You need to understand this very well. That's why we are going over and over these things again. Now, that's basically your swing high. And what are some of the importance of the swing high? So the swing high are used to identify resistance levels. Yes. The reason is we don't, after our swing high, if we break our swing high, we don't expect to go lower than our swing high. So price action traders don't really expect to go far lower than our swing high after we get a break of our swing high. Of that later. So relax and let's go through the session. Multiple swing highs at similar level often show resistance. Now let me see if I can get a beautiful example on the chart for you. If I can get an area on the chart, an area. Now look at this area. Look at this area. This is not a swing high. This is not classified as a swing high. This area is not classified as a swing high. But look at this. When two price action movement got to this particular area, it retraced and it happened again. It happened for the third time. What is that telling you? Telling you that that place is a strong resistance level. Let me look for an area I can use for that example. Good. Now, before this current movement, look at what happened here. Look at what happened here. We had a swing high here. Price failed to break the swing high, so we can have the area here too. Then what happened? When price got back to this area, price sold to the downside. That should tell you something. Swing highs, multiple swing highs at a particular area acts as a resistance. Or you can see, you can also use the order block theory. We learned that maybe the order block here is still acting as a resistance or as a ceiling to the price market. So that's another way of getting your support and resistance, which is the swing highs. So we can continue. Swing lows. Yes, swing lows are the opposite of swing highs. I told you in forex trading, everything moves in pairs. Whatever goes to the opposite direction also goes to the opposite direction in trading. So swing lows is the valleys formed before price rises. A swing low is the lowest point in the market move before the price reverses upwards. It forms when selling pressure weakens and buying pressure begins to increase. Now, what's the swing low? Let's take a quick example, take a quick look of how a swing low looks like on the market and see. Now, what's happening to this my chart? Let me lock it. Okay. Now look at this area. We could agree that around this area, price started creating lower lows, lower highs, lower lows. This is going to be our swing low. This is going to be our swing low, and the retracement and the swing low was broken. The swing low was broken around this area, and price retraced downwards. So this is going to be our swing low, and this is going to be another swing low around this area. So as you can see, very simple, very understanding. Swing lows, swing highs, swing lows and swing highs. Take your time, go over to your chart and try and identify them. Very important. They are the basics, but they are very key in our trading. Very, very, very key in our trading. We need them a lot to be good traders. That's why we stress on these things, but they are very important in our trading. They are the basics, but you're not supposed to have a look. You're not supposed to have a bad eye on them. You're supposed to take um very serious notes on our swing lows and our swing highs. Now, what's our next thing we should take care of? The next thing is our market direction. So this is like a summary. This higher high, higher lows, lower high, lower lows, equal highs and equal lows are telling us something. They are telling us market is either in an uptrend or in a downtrend. If you take a look, every time I said we're in an uptrend, we're printing higher highs and higher lows. Every time I said we're in a downtrend, we're printing the opposite, which is lower lows and lower highs. What is this saying? This is just saying that in uptrends we print higher movements, and in downtrends we print lower movements. But in ranging markets we print equal highs and equal lows, and we don't want a neutral market. Now, what's the main reason why we don't want the neutral market? The reason is, if you're in the market or in a position, you want your trade to hit your TP very fast. You're expecting your TP to hit like very fast. You don't expect your TP to wait. As a day trader, you don't expect your TP to hit in the next 5 days. So what do? We are waiting to get a direction that's going to help give our trades momentum. So that's where the uptrend and the downtrend comes in. The uptrend, having the higher highs, higher lows, you know price is ready to hit another higher high the next time it reaches. So you know where to put your target or your take profit. But when you have a ranging market, you don't really have a place to put your take profit, because you don't know where the high is, if it's going to get broken, or you don't know if the low is going to get broken. You don't know which one is going to get broken. So it means you are halfway in the market, which is very risky, because markets can turn at any price. Even with uptrends and downtrends, market turn on us. How much more a ranging market? So it's very, very important to take key or take note about this particular market direction. We don't trade ranging markets. Once again, we don't trade ranging markets. You can trade it, it's possible to trade it, but um it's going to go against you in some at a point in time. So we don't trade ranging markets. One more time, kindly like and subscribe, very important for those who are new here. This is the DanTrades mentorship, and we are taking everything through from beginner to intermediate. So kindly like, subscribe, and turn on the post notification. So yeah, let's move on. We have structural shift. Now, what is this? A structural shift occurs when the market transitions from one state to another. Now, we have two main states for price action traders. We have a break of structure, which is called BOS, and a CHoCH. Now, what's the meaning of the CHoCH? The CHoCH means change of character. Change of character. Now, let me explain this to you on the chart far more easier before we go over what we have in our PDF. So what's basically change of character? What's basically break of structure? Now, I'll be using these tools. I've explained these tools in application part 1. If you don't know it, kindly try watching over the videos and you get it. So this was my highest point. Price came down, created this. So it means I'm expecting price to continue going down, like at this particular movement. So price did what? Retraced and broke down, telling me that okay, at this point in time we are moving downwards. Now, ignore everything from this side going to the left hand side from this area. Ignore everything from this area. Imagine you just enter your chart and see this on your chart. You call this a break of structure. The meaning is you have this leg as a price movement, price retraced, and price has now broken the lower part of it. This is what you call a break of structure. So let me label this. This is a BOS. BOS. This is what we call a break of structure. Now, when price reverses and price does not follow the initial trend, you call it a CHoCH or a change of character. The reason is we were all going in a clear direction and you decided to turn your back on us. That's not fair. Turning your back on us is a devious attitude. So we call it a change of character in trading. So this area is going to be our change of character. Don't worry, I'm going to give another example so you have nothing to worry about. So this area is going to be our change of character. CHoCH, our CHoCH. Let me type it one more time. Good. So that area is going to be our CHoCH. More examples. Okay. More examples. More examples. More examples. More examples. More examples. Okay. Now look at this. Look at this. Look at this. Look at this. Look at this area. We can all agree price is going in a down movement. 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 Now, during all these price movements, we've not had a single CHoCH. Let me draw it for you. Price started from here, came down, went to this high, came down, went here, came down, went here, continued coming down. No change of character. No change of character. No change of character. And we got to this area. Now, look at this. When we got to this area, we expected price to break the low. But what happened? Price didn't break the low. Price went back upwards. That's where we have our change of character, because price is failing to follow the rule. Let me take this off. This is just something that helps you draw your market, like draw your structure. Very important too. Look, price was going down throughout until price made this mistake not to go further downwards but go up. This is our change of character. We've changed character. We're not willing to go downwards. We've just changed character completely. But what is the problem here? What's the problem here? The reason why you can't pick just anywhere as a change of character is because you have small price movements in your market. Now look at this. In that case, we can say this is also a change of character. But we don't want that to happen. We can say this small area is a change of character. But we don't want that to happen. We want to just indicate or observe the most probable change of characters and the highly influential change of characters. All these are change of characters, true, but they are not highly influential. We need the most influential change of characters to help us in our trading. What we want is the best. We don't want anything in between. So let's identify the highs and lows for this trade. So we have this high, we have this low here, which was broken. We have this high, which stood. This low was broken. Please try and use the tools. After the low was broken, what created a new high is this area. So this area is now drawn. This low then came. What created this low is, okay, I've drawn that. What created this low is this. Then the next thing is probably this low. Okay, ask yourself what created that low. And what created that low is basically this. This created that low. So that's going to be your last high. Now, you see, with this price movement we've created, anytime price crosses any of those, that's when we're going to identify that as a change of character. That's when we are actually going to identify that as a change of character. So look at this carefully. Go. Good. We had high, 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 high. The only 3 highs and 4 lows. Now we're expecting price to break this before we're actually going to believe that, okay, we are changing our character. We are actually changing our character. Then after that, anything that comes after that is going to break our break of structure. So price eventually broke this high at this area or at this level. Price eventually broke at this high or this level. So price basically broke at this place. So this is going to be our first change of character, and then we are going to have a new high. Our new high is going to be this area. This is going to be the high before it retraced. Look at this carefully. Look at this carefully. Very confusing, but if you get it, everything will go smooth. This was the high to be broken. It got broken. We called it a change of character because we didn't believe it was real. But it printed a high and price retraced and broke that high. We can now confirm that we are in a break of structure. So what comes in an opposite direction first is what we call the change of character. You're changing your lifestyle, you're changing your character. Then anything that comes subsequently after is a break of structure. I hope people get it. If you have more questions, drop it in the comment section. I'm here. I'm going to reply. You have nothing to worry about. All questions in the comment section, and you get a quick response. Actually, so that's basically what I'm trying to explain. This is going to be your change of character. That's the first area, and the second one is now going to be your break of structure. Every subsequent one is a break of structure. Every subsequent one is a break of structure. Now, this chart is not even that clear. It's not very clear, so it looks a little choppy, but you handle it. You handle it. It's something you are going to learn doing after a while. It's going to you're going to get used to it after a while. So that's basically it about the break of structure and the change of character. Now we can go back to our slide and understand what the slide is saying. So from the slide, we have that a break of structure confirms trend continuation. It happens when price breaks a previous swing high or low in the direction of the existing trend. Now, note in the direction of the existing trend. You can have a previous trend on your left, and you're going to see, okay, because you're having this on your left, you're not going to be like you're not going to place the trade because of that, because you saw a previous high, so you're going to believe in that high. Counter trend to what you have on your chart. No, the break of structure happens with the existing trend you have. It happens with the existing trend you have. Don't confuse break of structure and CHoCH. I'm pleading with you. If you have more questions, you can come into my DM. I'm ready. I'm ready to help you. You can come into my DM. I'm ready to help you. If you have any question at all, drop it in my DM. I'm willing to help you. Now, there's an example. Look at the graphical. Look at the graphics. Very beautiful. Very beautiful. I'm showing you charts on the break of structure. Yes, that's exactly how it looks like. This is the 15 minutes chart for card CHF, as you can see at the top left corner. Very important. You understand your charts, you understand your candles, you understand your quotes, you understand your B's. We've already spoken about all these. Kindly watch the previous videos or the first session, and you're going to understand all these very well. CHoCH, change of character. A CHoCH signals a potential trend reversal. It happens when price breaks a swing level in the opposite direction of the current trend. Very simple. We've spoken about this. This is very, very simple. You need to have computer time or trading time to get these very well. You don't just look at it. You don't just watch a trading video, or you don't just watch a YouTube mentorship video and get it. You need to go to your drawing boards, go to your screens, have some time with it, try and identify them. Very important. Now, those who have joined the Saturday session before know what's happening. What we are doing is we are trying our best to understand the basics or the components of the market, the basics, before we dive into the real trading. We need to understand this, because when it's time for us to speak about real trading, I don't have time to now come back and explain things to you guys. So you need to watch all these videos before we get forward. We have more interesting things. We are just in February. We'll be ending somewhere in July. So sit tight and try and get everything. Any question at all, leave it in the comment section. Change of character. So yes, I'm showing you some change of characters. These are mini change of characters. Now, if you look at this very well, there are mini change of characters. There's a slide. There's a slide from last year. I'll try and update it, but these are mini change of characters. We don't really pay attention to these anymore. These little change of structures, because we want significant change of structures. We want change of structures that are going to affect the market. That's the reason why I explained what change of character was on the chart before we came into the slide, so that you get the basics very well from the chart. So yes, if you didn't get it well, replay the video back and try and get what I said and a change of character and break of structure. They are very close. They are very close. Very close, but they are not the same. Now someone is asking if break of structure is the same as break even. No, break of structure is not the same as break even. Break of structure is far different from break even. Break even is under orders, under your orders. Break even, what's break even? So break even is when you are in a trade and you don't want to lose. You basically don't want to lose, but you don't trust that price will continue going your direction. For entry, that means that if price retraces and comes back, maybe you were buying. If price starts to sell, you should close the trade without a loss or without a profit. That's what break even is. So break even is a little different from break of structure. Break of structure is continuing your trend. You are continuing your trend. That's what break of structure is. But break even is you are already in the trade. You're in profit, all right, but at a point you feel like you're going to get in a loss. You're going to get in a loss. So you do what? You set your stop loss at your entry. That means that if price even reverses, your stop loss is going to stop you at $0. You're not going to get a profit, you're not going to get a loss. So that's basically what break even is, Tommy Walcott. So someone say disregard this. I'll make sure it will be out of the PDF after today, so you have nothing to worry about. Multi-time frame analysis. Now we are getting the whole use multiple time frames to know your structure of the market. So market structure isn't the same across all time frames. What looks like a downtrend on a lower, then an uptrend on a high time frame. Each time frame tells a different part of the story, from the big picture